If you skip adjusting entries, your financial statements will be wrong, even if every transaction was recorded perfectly. You might show profit that doesn't exist, or forget expenses you already owe. And that could lead to bad decisions, lost money, or failed audits. But don't worry, in this video, I'll show you exactly what adjusting entries are, why they're so important, and how to prepare them step by step, using simple examples anyone can follow. By the end, you'll know how to keep your books accurate and ready for final reports. Let's get started. So, what exactly are adjusting entries? Adjusting entries are updates made at the end of an accounting period, usually just before creating the final financial statements. They make sure your records match what actually happened. Sometimes revenue has been earned but not recorded yet, or an expense has been used but not paid or recorded. Adjusting entries fix that, so income and expenses show up in the correct period, not before or after. This keeps your books accurate and your financial reports reliable. Now let's talk about why adjusting entries really matter. Without them, your financial reports could be incomplete or even wrong. Imagine showing revenue you haven't earned yet, or forgetting to record expenses you've already used. That gives a false picture of how your business is really doing. If you're using accrual basis accounting, and most businesses do, then timing matters. You have to record income when it's earned and expenses when they're used, not just when money moves. Adjusting entries fix the timing. They help you match income and expenses to the correct period, so your reports stay clear, honest, and useful. There are 4 main types of adjusting entries you'll need to understand. First, accrued revenues. This is money your business has earned, but hasn't received yet. Think of work you've done, but haven't been paid for. You still need to record that revenue. Second, accrued expenses. These are costs your business owes, but hasn't paid yet. For example, wages your employees earned this month. Even if you haven't paid them yet, the expense still counts. Third, deferred revenues. This is when someone pays you in advance, but you haven't done the work yet. You can't count it as income until you've earned it. Fourth, deferred expenses, also called prepaids. That's when you pay for something up front, like rent or insurance, but you haven't used it all yet. You record only the part you've actually used. And don't forget one more common one, depreciation. That's how we spread the cost of long-term assets, like equipment, over time. Now let's walk through a simple example using the same small business we've used in past videos. Imagine this. You run a small design business. The month is ending, and it's time to make your adjusting entries. First, accrued revenue. You completed a $500 project on March 30th, but the client won't pay until April. You still earned it in March. The adjusting entry is debit accounts receivable, $500, credit service revenue, $500. This adds the income to March, where it belongs. Second, accrued expense. You owe $300 in wages for March, but payday is in April. The entry is debit wages expense $300, credit wages payable $300. This puts the expense in the right month. Third, deferred revenue. A client paid you $1,200 in advance for a 3-month project. By the end of March, you've completed 1/3. The adjusting entry is debit unearned revenue $400, credit service revenue $400. That recognizes just the part you've earned. Fourth, deferred expense, prepaid rent. You paid $600 for 2 months of rent up front. 1 month is now used. The entry is debit rent expense $300, credit prepaid rent $300. That moves part of the prepaid amount into expense. Finally, depreciation. You bought equipment for $1,200. You want to record $100 in monthly depreciation. The entry is debit depreciation expense $100, credit accumulated depreciation $100. This spreads out the cost of the equipment over time. Now, once all these entries are made, your income statement and balance sheet will reflect the true financial position of the business based on what actually happened during the month. This is the power of adjusting entries. They make sure your reports tell the full story. Before we move on, let's cover some common mistakes people make when working with adjusting entries and how to avoid them. Mistake number 1. Forgetting to adjust prepaids. Prepaid rent, insurance, or supplies often get missed. If you've already used part of a prepaid item, you need to move that portion to an expense. Mistake number 2. Mixing up deferrals and accruals. It's easy to get them confused. Remember, accruals are for things you've earned or owe, but haven't recorded yet. Deferrals are for things you've already recorded, but haven't earned or used yet. Mistake number 3. Adjusting cash. Adjusting entries never touch the cash account. Cash is only affected when real money moves in or out, not during end-of-period adjustments. So if you're adjusting for wages, rent, or revenue, always use payable, receivable, or prepaid accounts, not cash. Avoiding these mistakes keeps your books accurate and your financial statements reliable. Now let's zoom out for a moment and see where adjusting entries fit into the big picture. After you've posted all your regular journal entries, you create a trial balance, but that's just the first draft. Next comes your adjusting entries, the ones we've just learned. These entries update the books to reflect what actually happened during the period. Once those are added, you create a new report called the Adjusted Trial Balance. This version is accurate and complete. And from there, you're ready to build your financial statements, the income statement, the balance sheet, and the cash flow statement. So adjusting entries are a key step in the accounting cycle. Without them, your final reports could be off, and decisions based on them could be wrong. Getting this part right moves you one step closer to clean, clear year-end reporting. Let's recap. Adjusting entries are how we take raw transactions and turn them into polished, accurate financial reports. They make sure income and expenses are recorded in the right period, and they help you move from the trial balance to complete financial statements that reflect the real story of your business. If this video helped you finally understand how adjusting entries work, go ahead and like the video, subscribe for more clear and simple accounting lessons, and drop a comment if you want to see a full walkthrough of closing entries and year-end final reports. You're getting closer to mastering the full accounting cycle. Let's keep going.